We are in a buy the dips environment. That is not, it's not always true because obviously they fail and they are obviously go under. But the message is we're in a bull market. You want to be leaning toward buying when we have weakness in that kind of an environment.
Hello, everyone. Welcome. It's Rise Up, our weekly Wealthion show. We're very excited. Tomorrow's the 4th of July. We're all excited for that. You can see I've got my red, white, and blue on, celebrating America.
Terry, you look amazing.
Well,
I think
thank
we
you
haven't
very
been
much.
together in a couple of weeks, so it's really fun to be on. And I
Thank
love
you,
that you're
Joe.
sporting the full red, white, and blue.
Well, I still have such optimism for our country. So today's going to be a
How
good
can you
day.
not? Yeah.
There's a lot going on in the marketplace as our viewers, where it's been ups and downs, but we've got a lot of information to share with you today on such an important week in this country. So remember, we're here at Wealthion Rise Up. We've got experts here. As we talk about this, I want you to think about going to Wealthion for a free portfolio review. We've got experts that will help you standing by, thinking about how these changes are going to impact your financial plan, but also your portfolio. So Joe, please join me here. You're our co-host. We've missed you the last few weeks, but
I know
it is
so
great
much
to have you
traveling,
here.
and I'm happy to be home. I have all three of my daughters coming home with all their friends. I have 15 racks of ribs that I'll be cooking, which is, I think, a record. My last was 12, which hopefully none of the vegetarians are offended by, but that's what they all come to my house for. And we live at the beach, so they always are happy to come home, and it's a spectacular day here in California. I know it's scorching hot. I was just in St. Louis with you. It was quite toasty there, really hot in really all over the country right now. So hopefully everyone will have an amazing time with their family. Kevin, you're in Boston. I don't know if it's a little cooler there. It tends to be a little not quite as scorching there.
We've had some scorching heat. We had over 100 last week. Should be some good weather this weekend, so we're looking forward to it. And also, it's nice to have all my kids back at home too. So I know
And by the way, Terry, it's obviously I should never be on this show because all the market does is go up whenever I'm traveling because it's been amazing. Like, what an amazing run just in the last couple of weeks, really, with not a lot going on to drive it. It's not like we've had any spectacular news other than the big, beautiful bill seems to be progressing, but I'm not sure that alone is what's caused it. It feels to me the end of the quarter rush, lots of money rushing in, and we'll talk more about it, obviously. And there's obviously they're voting on the big beautiful bill right now. It looks like it's going through. They wouldn't have put it up, and that has lots of implications for everyone on this call. So we're going to
Well,
talk a bit
Joe,
about the
if
markets and obviously talk about the bill as well. So
Joe, if we have any viewers that write in that, they really want the market to still go up, we'll just take you off the show.
that's
Okay. So
right. Yeah.
that's just kind of how it goes. So viewers, you have a vote in this. So just keep that in mind. But
Okay.
anyways, let's go ahead, Kevin. Sorry.
I was just say I kind of like having Joe around. So
I do
either way.
too. I do too. We'll see what happens after this week. But
Yeah.
you have experts here for all of our viewers. Please write in. Please send us questions. This is your show. We want it to work for you. So let's hop right in to our big three stories. So the big three stories, we're going to begin with the markets. It's been a very, very good week for the markets, a record high for the S&P. Job numbers were released today. Very good news there. And the passing of our president's big beautiful bill on domestic policy. So we're going to dive in a little bit into that bill later in the show. But in the meantime, we're hearing about this concept called the Golden Cross, and this might be a new term for our viewers. So we have some excellent experts to share that with us. Kevin, would you like to share with us what the Golden Cross means and the implications for our viewers?
Sure, absolutely. So Golden Cross, it might be new to some viewers, but it's not a new concept. It's a very I guess well trodden concept in financial markets. So from technical point of view, the world's always obsessed with the 200-day moving average. It's roughly the average price for what a security or a market's traded at over the past year. there's 251 trading days in a year, but we always use 200. So 200-day moving average is important. You can see anytime a stock or a market gets close to that average, that can be a support or resistance level. But also, people like to they notice the cross when the shorter term moving average, which is a 50-day moving average, so roughly 1/4 of the year, crosses over the 200-day moving average, which is roughly 1 year. It's basically a sign of, hey, momentum's going back up. Things are starting to move higher. Historically speaking, especially with longer time horizons, it's a bullish signal. It's a sign of momentum.
And it's really, I think, a sign in the long term that we are in a buy the dips environment. That is not, it's not always true, because obviously they fail and they are obviously go under. But the message is, we're in a bull market. You want to be leaning toward buying when we have weakness in that kind of environment, because there's an undercurrent of money moving to the markets. Again, with all momentum indicators, when they fail, they completely fail, and you're on the other side of it when the golden cross turns negative. But for today, it's quite a bullish sign, and clearly it's just evidence of what we've all seen. Markets this quarter had a historically amazing quarter. We obviously started the quarter with a lot of turbulence, but we have surged through that big decline we had right when the tariffs were at their peak about a quarter ago. And it's almost like nothing has happened. That whole AI recovery has occurred. And in fact, we now have a chips deal with China, which is quite promising for NVIDIA. And so a lot of the frothiness, we've not had the pull through of earnings, but I think the other thing that's been driving this beyond the momentum is the economics. Like today, we had a great example. We were expecting a fairly weak jobs report. It turned out to be 147,000 new jobs. Although, interestingly enough, the private sector was very muted. It mostly came from government and healthcare. And I'm wondering if the Doge effect actually went into reverse. They went too aggressively getting rid of people, and they've had to rehire a bunch of them this last month. So the number actually came in stronger. And there's a push and pull here that's happening, Terry, that I think is very important for everyone.
Yeah, Joe, I just want to point out that, yeah, it's it's not a crystal ball. The Golden Cross is not a crystal ball. There's no guarantees. It may be an indication, but it's also backward looking, right? And we're looking forward, moving forward. So just keeping that in mind, it shouldn't change your overall strategy and your financial plan, but it should at least create a conversation with you and your financial planner to understand what's going on and how does it impact your forward-looking portfolio. Does that make sense, Joe?
Yes.
Yeah, I think that's where we try to offer the balance in this session, is that there are no crystal balls. But let's start moving on then we'll talk about the bond market and its passing of the domestic bill policy. This does increase U.S. debt by trillions of dollars, as you know. It leads us to our next big story around the dollar. It's off to its worst start in 52 years. And luckily, I don't remember the last change of the dollar like this, but not since 1973, shortly after the US went off the gold standard, has the dollar struggled so much. And just a couple comments, it's weakened 10% in the last 6 months. And when you use it as a measurement against the S&P numbers by converting it to euros, the rally we've seen is only a 15% jump. Meanwhile, the European stock 600, which has been a 15% rise, when you convert that to dollars, it jumps to 23%. So, there's some pros and cons here when we think about the weaker dollar. Joe, I know you're going to be doing some international travel coming up, but Kevin, can you talk about the upside for us as investors potentially?
Sure. So it's been a big move, and this is something to watch closely. Look, whenever you see currencies move, it's weird. It seems like currencies move, they kind of bounce around, then all of a sudden there's a big move and then a leveling out, and then it'll be a big move. But this is a very big move, 10% move. Look, when you see a move like this, the assets priced in the appreciating currency, they do well. And sure enough, if you look at the foreign markets are absolutely leading the charge forward year to date. The EFA index, that's Europe, Australasia, Far East, up about 19% year to date. S&P's up about, I don't know, 6 or 7 today, probably 6% through the quarter. So, what's important though, like anything, is there's a headline, but there's also, you got to kind of frame it. If you look at the starting point, the beginning of the year was kind of a really perfect starting point to show a decline in the dollar. The dollar had rallied in the fourth quarter. If you look back, before the election, say third quarter last year, the run in the dollar is really about a 5 or 6% move. So starting points matter, which is something that is true for really anything. But just one other quick thing, if I could squeeze this in, it's really important in the bond market, right? I mean, we've been in a period with elevated yields on treasuries. I've talked in the past about that 4.5% level in the 10-year treasury. But usually when you see high yields in the treasury market, it gets accompanied with I guess a stronger currency, because if you think about it, in a healthy market, there's a lot of yield we had in a country, which end up seeing is the currency end up come up, is there's more future demand for taking advantage of that higher yield and buying those treasuries, and there's more demand for currencies that are yielding more. It's weird to have relatively elevated bond yields and just a dollar falling off the cliff. So that's just something to keep in mind. We've all heard about national debt. We've heard about, it's going to be a problem, and it hasn't been, up until who knows. But that's something to keep in mind. If you see bond yields keep going up, and you see the dollar continue to drop, that's not a healthy scenario, and something that should be monitored.
Can I add, Terry? Couple things here. When you have the dollar going down this much, it's global companies, probably a driver for the market, because their earnings in euros translate back to US dollars in higher earnings. So it depends on whether they generate earnings or expenses in foreign countries, like anywhere in Europe as a continent. So that matters. Like earnings, if the dollar goes down and you're making a lot of money in foreign countries, increase your earnings here in the US when you translate that currency back. But it can also be inflationary, and it's quite amazing. The inflation numbers have been very muted. I think the overwhelming consensus is tariffs would increase inflation. A declining dollar should absolutely increase inflation, because all of the stuff we import should be coming in and it's more expensive. And yet we've seen no impact of that. I do think it matters as to what the Fed is going to do, because as long as the dollar's going down, and we're net negative, and this big beautiful bill, which we'll cover in a second, is going to add even more debt to our needs. It's an interesting situation that we have higher and higher rates to attract the capital that is being more than offset by the decline in our currency. So if you're a foreign investor, a Chinese government that buys US debt, and you're getting 4%, but the currency's fallen 10%, your net capital has actually declined in value by 6%. So that is all of these equations, because we do need foreign money to fund our spending. And that number's not going down. It's trillions and trillions. So I think it's ultimately has an impact. Right now, there's just so much momentum going into the stock market that and again, I think we'll talk about valuation, but it's a little bit of a concern to me. And these things are all ultimately always linked. They don't ever stay apart for too long. So there will be an adjustment that occurs one way or the other at some point.
Well, Joe, I certainly hope that you're bringing a few more shekels with you when you go to Europe in a couple weeks, because we all know a falling dollar. You don't want to
travel with my wife and 3 daughters, who will eat one bite of the €25 hamburger,
And it's not just food, it's going to be transportation,
it's
going to be airfare, and any type of shopping that you want to do in Europe, which I know your family will love to do. So, but let's go on to the third story, which is the July 9th tariff deadline is quickly approaching next week. And this week we saw a deal with Vietnam, and there will be no tariffs on US goods and a 20% tariff on goods coming to Vietnam. So that's exciting. And what for perspective, what that means in 2024, the U.S. imported about 136 billion in goods from Vietnam and exported 13 billion. So these are great stats, but Joe, what sectors do you think are going to benefit from this deal?
Well, look, Vietnam is a big hub for a lot of manufacturing, especially things like clothing. That was what was assumed to be the safe spot, India and Vietnam, away from China. And it was thought that the original intention of the policies of tariffs was to encourage companies to work more outside of China. And Vietnam was one of the friendly spaces for Apple and for clothing companies, etc. I think the market just wants clarity. So here we have one big example of a relatively big, not huge, but a relatively big economic partner of ours that the trade terms seem pretty good for us. You know, we can go to their markets with no cost, and we basically generate revenues when they come in to offset the difference in costs of manufacturing in each country. The reality is, for manufacturers, just knowing what the rules are allows them to make the business decisions they need to make. I think the more of these we get resolved, the better. The most encouraging thing to me that I think the market is taking heart with is that we're not trying to prove a point here. We're just trying to make the trades fair. And as long as that's the goal of the tariffs, it's not to punish people, but to just equal out the trading imbalances, that the rules of the game, that does not bode badly for the market. It's that there was a while there when the tariffs were at their peak, saber rattling, the discussions, that it wasn't sure how far we were looking to really go. And is it really about generating revenues, or is it really about balancing the trade? And the more the president is focused on, we just want to get fair deals with each country, the better it is for us. And obviously the hope is here, one domino falls, the next one will fall, the next one will fall, and get some momentum behind getting all these deals in place. And tariffs, I think, have fallen to the wayside as an issue right now, because it seems like the market kind of taught a lesson to the administration, and they're listening. They're basically saying, okay, let's keep it within the narrow universe of creating a fair playing field for everyone. And again,
Yeah.
I think the market likes that.
Yeah, it seems to be that way. But, July 9th is coming quickly. And Kevin, we're not going to have all the deals signed by July 9th. And what are some of the impact for some of these deals not getting done by July 9th?
Yeah, so I think Joe has some really great points there. I mean, Vietnam, I think, is a really good example. I think Vietnam was 40% tariffs on Liberation Day, and they're 20% now. It's a good example of Trump's and this administration's, I guess, negotiating tactics, the art of the deal. You anchor to a big number, and you're willing to settle somewhere in the middle. And I think this is just an illustration. I think it's a good signal to other countries. There was a deal with England. There was a trade truce with China in May. I mean, not a deal, but a truce. And there's been definitely some softening in that trade war that was ignited earlier. So there's a lot of hope. I mean, I feel like the biggest downside is the market is pricing. It's pricing for perfection, I guess, or close to it for tariffs. I mean, the market's setting all-time highs now. So fastest. It wasn't a 20% correction by a close, but the fastest 19% correction ever, down and back up to new highs. So I think that's the biggest thing is expectations. But there's still a lot of still some rows to hoe here. Europe's tough. Trump said as much. Europe's kind of tough, but those negotiations are happening as we speak. Japan seems like there really is little to no deal progressing there. But that's probably a lot worse for Japan than it is for the U.S. They're facing 30% tariffs on the 9th. So again, the risk is that things don't happen, and that now the market's got to price in some problems. And if that were the case, sectors at risk. I mean, I don't think there's anything shocking here, but industrials, I think would they have complex supply chains. They've had a really good run. They have second order risk with a decline in the economy if any sort of trade war or escalation of tariffs ended up leading to recession. things with China look really good right now on a relative basis. But if there was ever a re-escalation with China, then obviously semiconductors, would be a place. They've had a really big run. Joe mentioned that earlier. And then I like to always frame things in as far as what just happened the most. I don't know if you know this, but growth just outperformed value the biggest in one quarter ever in the past quarter. I just got that stat this morning. So
You know what's crazy, Kevin? We thought the tide might have turned in the first quarter, and it's like, no, head fake.
Yeah, there it is. And a lot, I mean, semiconductors, big tech, the AI, Joe, you mentioned the AI trade, not only coming back, but just shooting forward. So there's probably some potential weakness there, but we just mentioned it, 5 minutes ago. The foreign markets have been on fire, and a lot of it's been currency and other reasons. But also, I think if there's an escalation of the trade war, you got to worry about some decline or outsized decline in developed foreign, the Europe, the IFA.
And when you look at Vietnam in particular, the biggest single chunk of what gets manufactured there are electronics like smartphones, etc., computer chips, etc. Number two, it's machinery and mechanical appliances like big, heavy machinery, industrial stuff. So computers and electronics make up about a third of all of the imports that come from Vietnam. The second big chunk is machinery, and then it's really apparel, footwear, stuff in your house, furniture. That's the other third. So those are the big things that, again, it depends on how the manufacturers are going to put through that 20% tariff, which is now going to go into law. And not all of it's going to be kept and consumed by the builders or the sellers. They're going to pass some of that on to consumers. And so it's a lot of the stuff that is probably sitting in your house right now.
Yeah, I mean, ultimately, at least today, we could think about this would put less inflationary pressure, which might be good for the Fed outlook potentially, but it's really going to provide some relief, at least in the short term, for the tech industry, the industrial industry, and then the retail and consumer industry if this continues.
And Terri, before we go to the big, beautiful bill in our topic, I did want to say that one thing I would be keeping an eye on for most people now is when is good news bad news? Because I had thought that perhaps if we got some bad news on the employment number today, that would get people actually positive because the Fed would be more likely to drop rates. And it's a significant change in the likelihood of, I think the projections now are going from 75 basis points of cuts down to 50, which is not a small thing. And the likelihood of a cut happening in July went from 30% to 5%. So there's almost no likelihood there'll be a cut in the next month. And we're expecting now, at least the pundits are expecting now a significantly reduced amount of cuts, just 2, or a total of 50 by year end. That's going to have an impact. It's good for our savings, obviously, but at some point, if the labor market picks up again or the economy picks up again, it removes the possibility of the Fed dropping rates. And so I think the Fed's in a tough spot here. And we obviously know that the president's putting a lot of pressure on Powell. If rates were to drop, that would be quite something for the market because the market's doing incredibly well given what we see in interest rates. It's remarkable to me, honestly, how quickly the recovery happened.
I think about our business owners out there right now, our smaller, medium-sized business owners right now, with all of this whiplash, not knowing what to expect. But it does have an impact on potential interest rate cuts. So something our viewers, we want them to stay tuned because we'll translate this each and every week. Kevin, was there something you wanted to add?
Yeah, I'm glad Joe brought that up. I was gonna bring this up back when we were talking about the unemployment or the employment situation. We're in one of these really nice periods for the market where it's kind of heads I win, tails you lose. Where you look at some of these economic numbers, and if they're stronger, it's like, hey, great, the economy's stronger. This is a good thing. And then if they're a little bit weaker, you're like, hey, great, the Fed's more likely to cut rates. So it's almost, and that, I think I was anticipating that the market was going to view today's employment release in exactly that, that frame of reference where, if it was weaker, it could actually be a positive because of the higher likelihood of rate cuts. And Joe's right. There's a lot of room to cut rates here. And that's why if you're worried about recession, I mean, I think about recession too, but there's a lot of bullets in the gun. And certainly the data would support, at this point, all things equal, the data, again, if you take tariffs out of it with the uncertainty, the data supports some rate cuts here.
I agree.
Now there's, the big, beautiful bill. I just learned that it did pass and it is going to the president's desk to sign. So this is just off the presses. So it has passed. And, for all of you viewers, there is something in this big, beautiful bill that will impact you financially over the next several months and years. And so when we look at it overall, besides extending the 2017 tax cut, it adds even more tax breaks, including no taxes on tips. And, my youngest daughter is a waitress, so she's pretty happy about this. There's no taxes on overtime pay, a larger tax deduction for some seniors, a boost in the child tax credit, expanding the cap on state and local tax caps, raising the estate tax exemption, and moves to help small businesses with their tax burden. So, Kevin, it's really times like this that people could really use a wealth manager to sort through this and the impact on their portfolio and their financial plan. Could you give us an example of what you're telling your clients right now and going over their financial plan?
Sure. Well, I guess it's Trump's world. He gets to sign his new bill into law on the 4th of July. Now I can remember back when I earned tips. Back then they were mostly cash, so I don't know how many taxes are being paid out of those anyway. But anyways, but I shouldn't have said that. I was only kidding, Iris. Anyway,
I think they actually manage that pretty closely at most restaurants. At least they do
yeah,
now.
they do
You're
now.
an,
They didn't.
you're an
30
older guy
years ago.
back then.
I
Yeah.
didn't hear that. I didn't hear that at all, Kevin.
Yeah, I was joking. It was my jest. Anyways, I mean, just with this or any policy change that impacts someone's plan and their financial life, it could be a big deal. It could be a lot of work. I don't know how much this one is going to be. Probably a little bit. I'll get into one thing in particular, but it can be a lot of work. I mean, our financial planners, they'll go in, they'll dissect the entire bill. They're going to write opinion pieces. They're going to create action plans for all the advisors to bring specific issues to clients. We're going to screen for clients that may be affected by certain points and proactively reach out to them, schedule meetings and implement changes if necessary. Again, I don't know how much is going to come out of this particular bill, but I mean, just it is an example. The estate tax exemption, $15 million for an individual, $30 million for a couple. I mean, that could be impactful, I think, especially for wealthy families that are gifting out of their unified credit, with their lifetime exemption. There could be legacy planning, legacy gifting, funding irrevocable trusts, moving assets out of estates more than have already been done. That I think could be something that we're spending some time on. And always, it all comes back to taxes, right? It's tax optimization. It's finding strategies that affect income, affect capital gains, affect estate planning. We're just always looking for opportunities for tax savings for clients, and so I'm sure we'll be spending plenty of time on this.
And
one.
Terri, I would just say there are three big things to consider here. The first one is most of the impact and the cost of it was that they had factored in this expiring, the tax deduction that came in the Trump administration's first. But it's for most people, most of it is this just keeping things the same. So
Right.
The massive increase in cost is just relative to the fact that it was meant to expire. We were meant to go back to the old tax regime of 39.6% at the top end. And that alone is not going to affect people. It'll keep them where they were a year ago, but not where they would have been had the tax bill expired. Because again, the way they made it through the first time around was to make it limited in scope, only last for 8 years or 7 years or whatever it was. So that's the biggest impact. It's just keeping things the same. Now, there are two ways in which it really does impact. the SALT exclusion going from 10 to 40,000. So if you're in a blue state, it's mostly who gets affected: New York, Chicago, Illinois, California, places with
California.
high state taxes.
Massachusetts.
You could only offset $10,000. Now it's 40,000. So that's real money in pocket for people who are in high tax states. Now, again, you're excluded if you make more than $500,000. So if you're high net worth, it has zero impact on you. But if you're in these states, that's considered middle class, 100,000 to 200,000 in income, because rents are so high and home prices are so high. You are going to benefit from this. You are going to get money in your pocket from that. And then obviously they're permanent now, so you can plan around it. As Kevin mentioned, we've increased the estate tax to $15 million per family member. That's not insignificant. That's people were planning on it going away and going back to the old $2.5 million. It's actually grown. So that has very serious financial planning implications. And it's unlikely to get waived, certainly in several years now, because it's too big a battle, and the Republicans control the entire administration and the House and the Senate. And then the last one that I do think matters for people, again, who live beyond taxes, beyond their tips, is thinking about the corporate tax being permanent at 21%. So many business owners, you mentioned, of course, many of them are S corps, LLCs, which are more like personal income tax levels, but it allows for predictability. It's not going away. And again, the market loves predictability. For us as financial planners and advisors, it's really helpful to know what the rules of the road are. And so again, what we have now is some clarity. This isn't expiring next year. Now, I'm sure if the Democrats win, they're going to come with their own big, beautiful bill that might have higher taxes. Who knows? But for today, we don't have this expiring thing. We have certainty, and that's good for everybody.
Yeah, Joe, I like to think of it as a CFP is we're moving from watching a deadline to now into the design mode. And it's
Exactly.
really about thinking about your long-term plan, because we do have a little bit more certainty now. And the things that I think about is multi-year tax planning, especially as you're thinking about charitable giving. This is an option, again, for donor advised funds to really take advantage of that. And then Kevin already mentioned, but family office strategies for those that are living in those blue states and have more than 500,000. This would be a time to go see your wealth planner and to get a financial plan and make sure you've got a long-term plan. And I want to just highlight again for Wealthion. Now, this has implications for you. So go out and get your free portfolio review for Wealthion. Talk to one of our fiduciaries so they can help you think through this now as the design plan for your life and your legacy that you want to
For
leave.
investing, why this matters, Terry, that they do this, they took away the credit for green energy and they boosted spending on defense and border security. That's going to have portfolio implications. Obviously, if you're retired, there were some changes made to the Medicaid policy, which you should be thinking about, and how does it impact you? So there are many, many ways in which this is going to impact your day-to-day. Although for most of us, the tax returns will be kind of the same. The people most affected are the people who make less income and rely on service industry, and obviously if you're living on fixed income and you have Medicaid costs, this is a pretty material impact, and it's basically encouraging you to go get a job, or you're gonna have definitely higher healthcare costs.
Yeah. So let's also talk about the impact of the bill passing on the 10-year Treasury yields. It's jumped immediately, but it adds trillions of dollars to our US debt. And the bond markets have been very jumpy about this debt. Joe, I'd love to hear from you. Should people be heavily invested in fixed income at this time, or should they be worried?
You don't really have a choice if you're retired. So let's put that on the table. So what you really have a choice is how far out on the risk spectrum do you want to go? You're getting around 4% for cash today, 3.8 or something like that. And you can get about 4.5% if you go out 10 years or more. And so you're not getting rewarded for that increased possibility if rates go even higher. So I like to just have a laddered portfolio. I know, Kevin, that's what you do for your clients, where you have investments in all parts of the bond market. I do think the likelihood is that rates will come down over time because we priced it in. Now, the market was closed when this bill passed, but I think most of the market assumed it was there. And the biggest issue is if the dollar keeps going down, in order to attract investors into our debt, we're going to have to keep rates higher for longer, both the short term and the long term. So again, you have to generate yield. You can also, as Kevin, I'm sure we'll talk about, is go to other versions of income. You can get income from real estate. You can get income from secured debt. So you can have other income sources other than the US government in order to generate yield that's maybe more predictable and less exposed to short-term fluctuations in interest rates. But the biggest impact when you have debt, what's the maturity? What's the average age of the bonds? Because the further out they are, the more exposed they are to shifts, good and bad, in interest rates.
Yeah, the other big impact on the bill is on Medicaid, as you know, and SNAP, which isn't this, it's the Supplemental Nutrition Assistance Program. And, Kevin, we've been talking this year a lot about healthcare and the value of healthcare stocks in the sector. Does this have any implications as you can see it?
Probably some, but probably not a lot. I mean, healthcare has been under, as we all know, it's been under a lot of pressure. There's a lot of negativity built in. So I don't know that this is going to, move the scale any more than it already has. Healthcare's got a lot of headwinds. RFK and the MAHA movement, make America healthy again. Lower drug prices, sales practices, regulation. Same thing with food in the consumer product space, a lot of fast food and processed food. So, there's just a lot of headwinds there. But I mean, for a long-term investor, probably a value. I mean, you got to be looking at things when they're out of favor. Certainly out of favor at this point. Just not as sexy as buying an AI stock.
And you can get nice yield from some of these stocks, which is nice. So if
Yeah,
you're a
they play a
conservative
role in your
investor, you
portfolio.
get the earnings and you get paid usually quite well with very nice dividends, especially now with valuations having come down. So you should always think of going where no one else is, like that's the Warren Buffett adage, especially as it gets more and more heated. Think about diversifying investing. Again, a good reason to have a portfolio review. What's the average maturity of your debt? What kind of equity exposure do you have that could put you at risk? And what's the multiples and the dividend you're generating from your portfolio? This is all the kind of work that you want to have done for you so that you make good choices. And I know we've got a 4th of July looming. So next week is a brand new week.
Yeah, let's talk about the stories for next week. It may be a potentially a quiet week for data, as the major drop will be the minutes from the June Fed meeting. Kevin, are you expecting anything from those minutes?
Snoozer. I don't think there's going to be anything there. I think Joe had the stat earlier about the likelihood of a cut in July. There's nothing really to talk about until we get past July 9th and hopefully get some clarity, good, bad, ugly, whatever it is, doesn't really matter at this point. Just some clarity on what all the tariffs are going to be, and then at that point, like I mentioned earlier, I think there's obviously plenty of room for the Fed to be cutting rates, but with the economy being as strong as it is, and certainly with it, I just they're not in any rush. They don't need to be in any rush. And I honestly, I know Powell gets a lot of criticism. I think he's done a very good job all in all navigating all of this. And I think, I think you can afford to take time right now, and they'll be cutting rates at some point.
Yeah. So July 9th is coming. Joe, do you want to make any big bets on which tariffs will be settled and which ones won't?
Any
think predictions?
I have given up on trying to predict the next twist in the road. My suspicion is that there will be an extension, that in the very important ones, he's going to say, well, we're working, we're close, we're going to go another month or so. I think he wants to keep the heat on. So maybe he'll say no. And then if the markets react strongly, by the way, if we don't extend, that won't be taken well by the market, especially with valuations where they are. We've not talked a lot about where we are now in valuations. Maybe next week, that's an interesting topic. But we have very little wiggle room for a big economic shift. And so again, my hope is that he'll be firm, he'll be assertive. Maybe he'll hang up one country as an example to say we're not extending them, but it's not going to be a China or an India. It'll be someone that we can afford to use as an example. And we're starting to get a sense for his negotiating style, which is wave a big sword, make it very big, and then defer. And so again, even if he does let it expire, I suspect that the markets are not going to react as strongly because they think it might be a bluff. We'll see.
Yeah, so that really, ends our show today, but I want to make sure that we enjoy the 4th of July holiday and maybe take a little bit of a mental break from the markets and everything that's happening to enjoy your families and your friends. Joe, you mentioned you were doing a big barbecue. I don't know if it's really good to play volleyball after you eat all that barbecue,
I do it before. We have to get up
okay.
really early to reserve a spot at the beach. That's usually 4:30. And then we play sunrise volleyball. And then I put the ribs in there.
Oh my gosh.
Yeah.
4:30 in the morning to play
Yeah.
volleyball. You're nuts. So I'm glad you're not my uncle. That's all I can say.
Uncle Joe.
Yeah. All right, Kevin, what are you doing for the holiday?
Well, we usually go to Cape Cod, Massachusetts, but we're not this year. We're gonna go to the South Shore, hang out with some friends, and then I guess we'll be local. But we got all the kids in house, and probably a couple smaller cookouts with no ribs. We're sticking to hot dogs and hamburgers. We're simpler in my house, but it's gonna be a great time. And Terri, I hope you have some fun plans too.
Yeah, we do. We're going boating. We're near Lake Shasta, in Northern California. It's about 105 degrees up here. My whole family's here.
Wow.
We do e-foiling. Have you guys ever done e-foiling before?
I want
It's
to.
like it's a surfboard that goes above the
Oh,
water. I'll send you guys a picture. It's
I've
really a
seen
lot of
that.
fun.
Yeah.
All my kids do it. Yeah, I'm okay at it. I'm learning and growing each week, but it's
Okay.
a lot of fun.
Well,
But
happy
everyone,
4th, everyone. Thank you,
yeah.
Terri.
Yeah,
Kevin,
thank you,
great
Thank you.
Joe.
seeing you.
Thank you, Kevin. I hope
Great
everyone
to
has a
see you.
happy, safe 4th of July. Please join us. Please subscribe to Wealthion. Please let us know if you have questions, and thank you.